Hello guys, and glad to have you on board again today. We had the inauguration, and actually just like we forecasted yesterday, nothing actually happened. We were still going ahead of probabilities, very low probabilities of some more jitter and noise out there, and therefore that's the reason why we've talked about possibilities for the market to reach out for some potential cover trades. And yesterday we were trading right at the expectable areas for such a thing to occur, which is typical third range boundary. We do have upside trends, and therefore if a risk could emerge, the market is supposed to test third range boundaries. And of course, as the risk will either manifest or not, then depends on what we'll get out there. So either we are going to validate the third range boundary and then break it, or we're going to validate and confirm and cause a reverse, or we're going to just break through it, causing it to be a squeezed third range boundary. That's exactly what we've had yesterday. Let's go to the 4-hour chart, or eventually 1 hour, and you'll get through it. So yesterday we were dealing with this area, and as you can see, if you have a look at it afterwards, you'll see that we've created this wedge structure. So as you can see, no signals to trade. We had cycle confluence, we had a divergence, but we never managed to get a price confirmation. So price never reversed. It accumulated and broke to the upside. So what we have in here is not even a validated third range boundary. Validated would have been price testing the trend channel, which it didn't, so which means no one even cared. So what we have in here is what we call a squeezed third range boundary, which means we've dealt with a risk management area without risk limiting. So no one cared about this area, we broke through it, and that generally means that those of you who got into this third range boundary without the signal had to take a stop loss. And of course that's something you know about. If you get into a trade without respecting the rules, you're increasing the risk taking and therefore the likelihood of a stop loss to be taken down. So that's exactly what happened. Okay, so the market went up, the market has squeezed the third range boundary, which now means that we've priced in, or we've accounted for the possibility of a risk to show up, but the market decided nothing actually showed up, and as you can see, it hasn't been waiting for the actual inauguration to start. The market somehow knew in the beginning that nothing would happen. So that's the beauty of the market, of course, and I'm still, years after years, absolutely staggered by the capacity of this market to deal with information ahead of information actually being publicly released. So of course, from time to time, this is not working properly, of course. So when the market goes wrong, you see how dangerous it violates prices later on. But still, I can hardly say how good the market is into forecasting stuff. So still, we're breaking this third range boundary, which means now and for on, and until further notice, no one should get to short sell this market. This was a risk limitation area, and as you can see, we just fucked up this risk. And prices are going bullish. We lack of volatility on the higher time frames. So there's nothing you can do about it. You're just gonna have to let it go. If you try the third range boundary, then, well, that's a stop loss, and it happens. So despite that, that doesn't mean we're done. There was a risk, the market doesn't care about it, so, well, the only conclusion is let's move on to something else. So for green guys, beginners and stuff like that, there's nothing more you can do. There was a third range boundary, it just didn't work out. That's the end of it, okay? But still, for experienced traders, we've got a shitload more things to do. And more importantly, when we have a squeezed third range boundary, experienced traders know that we immediately plot the 1-to-1 ratio and we're going to get to sell it. So that's as simple as it is. There was no risk, but we just can't go to the stratosphere because that's just a risk that didn't show up. So we squeezed the third range boundary. We're going to have to test it as a support right now. The question is, of course, those patterns are not the easiest one to navigate. They come with a high level of risk, and they come with a specific type of signals required to trade these, and most importantly, most of you guys are not ready for it. They require psychological, very, very tight management, which requires a level of knowledge and experience that most of you guys simply don't have. And it might sound simple when I say it. Well, Phil, I can see your third range boundary squeeze, and I can definitely sell. And more importantly, as you do it, I can do it. Well, that's not about it. You definitely need to learn more about trading, because even if I told you which trade I take and for what reason and where do I put the stop loss, where do I put the limits and stuff like that, you would probably not make it a successful trade. Or there will be probably a difference out of the way you'll manage and the way I manage. For a simple reason, we are not equal persons. We feel different stuff, we have different emotions, and we handle these differently. So this is where experience pays a shitload of difference between a beginner and an experienced traders. And these are really, really subjective stuff. So just trust me on this one, okay? Until further notice, this is no longer a market for beginners. This is a market for experienced traders, and most importantly, really experienced traders, because we're dealing with lack of volatility on the higher time frames, which certainly doesn't make it easy for those who are trying to sell this market, because we are into a 45-degree angle pain trade upside market. Not enough volatility because the trend channel is so narrow and totally stuck into the resistant context. So these things can simply go on for much longer than you think. But the fact is also that we are trying to break above the 4-hour context, which we do not do normally in wave 1 extended trending structures, okay? Wave 1 trending structure generally get to make multiple closes above the context on the extended wave, which is the trend wave, and generally later on the catch up on waves are generally slower. Remember that, you catching on the crumbles instead of trying to turn yourself a billionaire. So I think there are limited gains to the upside, reason why we are still with the experienced guys going for cover trades or net bearish tight expositions, but really tight. We know that there is not that much bearish potential either. But let's make it straightforward so you guys understand the process. I'm looking at covering the portfolio since then. That's the point in which I started, okay? This is the target I will chow to. I'm not going to target any more than that, okay? Which means just take it as it is, okay? Jesus, I'm going to be able to make it. I'm going to grab the tool actually because it's so shitty not to do it. Yeah, price range. Okay, so let's assume that going up there, come on, okay, here it is. So we would be 145 points above versus on the opposite direction, a potential to grab 200 points. So at the current given time, I'm still taking and accounting for this type of loss on my account for cover trades, okay? But in the opposite hand, like I said, cover trades means you have bullish trades. So it's pretty much like a null situation. These losses I take them as a gain on the bullish portfolio, on the stock investment portfolio. So there is a totally weird mixture. Like I said, covering isn't meant to be making gains. It's just meant to cover for potential downside risks. So at that point, someone who took a cover trade early December and will more than halfway through January will still be fine, which means for the potential of losses that you want to cover, you're still not losing more than that and you're still compensating. So this is not a raging bull market that we're experiencing right now. It's more like a slow pain trade for those who don't have the necessary psychology for it. Okay, that's most importantly even more a pain trade for those who do not have a bullish portfolio and are just trying to short sell a market that doesn't want to go down. But it's not exploding to the upside either. But if you are net short into this market, out of a context and out of a risk limitation and don't have the mindset or experience, you're just going to really turn yourself into a fool. So don't get me wrong, these things can go on and go on. Not forever, but they have... normally, we know that the extended wave is definitely the longest. So in here, we have a low point in here. We have gone on for quite a long. But if you can see, we're pretty much halfway through what we've done back then. So I think we're getting to mature. But the question is still about the timing. Is this going to be the market top in here? Who knows? We could eventually ride a wave flat for a second, going higher later on, and just afterwards going low. So if you're rushing in right now or thinking about end of the world type of things, yesterday is just one another of those days that just remind you that, well, we do have some rising tensions. Yes, we do have. We might have some negative feelings about this market because lots of retail, unexperienced traders are getting into the market with irrational behaviors, cryptos being just one of these, but not just this, okay? It might turn out to be irrational, and to be fairly honest, it already is. The thing is that that's not what we trade over. That's the sentiment. Sentiment gives you a context to trade. That certainly doesn't give you a trade all by itself. So you need to trade context. And like I said earlier, and that's the only conclusion you can get down to right now, is not a market for beginners. Beginners can trade third range boundaries, and as you can see, multiple third range boundaries have just been fucked. In here, this one didn't work out. We broke, got to the exact 1-to-1 ratio, and retraced the third range boundary. I'm making this exact same trade today. Third range boundary, broke, 1-to-1 ratio, I'm selling. But I'm also totally aware that we're probably not going to do this. It's not going to produce the gains today, neither tomorrow, probably maybe next week, but it could even take more than that. All I know is that in terms of risk-reward ratio, it is interesting for speculators, experienced speculators who know how to handle psychology, kind of trendy trades, which requires a definite psychology, and we're not going against the market because we think it's going too high. We're just exploiting a pattern. Okay, and that's a mindset most of beginners or intermediate traders simply can't handle because they're not mature yet. Okay, so that being said, just trust me on this one. You don't trade this market anymore until we make daily candle closes below this third range boundary. Okay, as long as we stand on top of it, just stop trading. Don't look at selling, don't look at buying. Like I said, go back to the previous plan, which is on a day-to-day basis, trade against the retail sentiment. What have the retails done yesterday? Oh, let's guess it. They are buying the fucking market. They're selling the fucking market. Market goes up, they're selling. They're just doing the opposite. I've always told you that. So now that they are going on the opposite direction, what am I going to be doing? I'm just going to exploit my patterns, but I take limited position sizing. They are going to sell. So if I sell, I make sure I sell with a pattern, and I make sure I am patient and I am using lower position sizing than a normal trade. Normally in this reversal context on a 1-to-1 squeezed third range boundary, I would risk 1% capital. I'm taking half of it. That's just the thing. They are selling, so I'm doing the same as they do. Definitely not in the same price area. I'm having a better spot, but still, I am totally aware of the fact that I'm doing the same thing as the retails do, and therefore, I need to be cautious. Reduced position sizing. Okay, so that's the message for experienced guys in here. We're going with the retails, so we need to be smarter than them by reducing our position sizing. And we'll, of course, get to buy the market later on, okay? It's, of course, that. We're still oscillating bullish, bearish within the next few days. As long as we stand with a daily candle close on top of 3,800, there's no reason to be excessively bearish. So we're going to buy or sell on a day-to-day basis, depending on what we have in front of us. Okay, that's it. Despite that, we have to also assess the fact that we must have a look at USD WTI and 10-year yields as a reference point of the actual market sentiment. And just have a look at these. Nothing and nothing. So the stock market rallied, but the rest of the market hasn't moved a bit. So do we have a bullish trend emerging and raging bull markets into the US? We do not have that. Otherwise, these guys would have sent a message as well. They did not. So it's boring. It doesn't send us any reliable tradable signal. It's just pure fucking noise. So you would say, then why is the stock market rising so high? Because there's obviously a bullish trend. There must be. Well, like I said, there is not. Most of the trend already happened. All we have to work around is the crumbles. That's the only things we can try to catch up onto. And just like I highlighted earlier, this is a market that just barely risen to 4% since early December. And like I said, it will probably erase all of these gains in just a few days later on. So this is not value increasing. This is just price rising because there are limited risks on the opposite hand. And we live in a world in which a risk that doesn't show up must produce gains. That has created quite of a crisis back in the days, but still, that's the world we live in. When we have a risk, when we perceive a risk, and when the risk doesn't show up, we must account some gains. That's what we see on the stock market nowadays. So we have this 45-degree angle, low volatile market. It will probably erase all of those gains sooner rather than later, but who knows? And until now, we need to manage the risks of being proven wrong. Because this is not because we have that I know what the future is made out of. Because possibly this thing can do that. And if it does, then whoever is short selling the market is going to have a lot of troubles. So that's not what trading is all about. Stop forecasting the future. Just make some goddamn plans. Assess the difficulty of the underlying trades that could come out of this scenario and take the ones you manage. The others, leave them to those who are able to do it. That's what it is. Progress slowly but steadily. All right. That being said, we'll go a quick look into cryptocurrency. We might figure out that the Ethereum is on the verge to fail, but still, that's still hard to figure out. I can hardly see people who've missed the divergent structure that we can see in here. It's a double exit pattern. So totally forecasting myself into the fact that we're very likely going to fail on this on this all-time high. But like I said, I don't think it's a failure that will cause a crash, whatever. Definitely not even a sign of it. Okay, it's just that there's a shitload of volume to process into this area. And it has started back then because, like I told you, this is the area in which the smart money started to lock on their buy and hold gains. Okay, they will probably take partial profits, and on the opposite hand, we do have some demand. So that's the reason why prices kept pushing. I see the divergence, and once again, divergences are patterns of generally trending context. The market goes divergent when it's trending. So pay attention to this. We clearly have shifted prices from point A to point B, and it seriously should tell you something. This market is trending, yes, but we've gone really, really fast. That's the reason why cup and handles and stuff like that could be some solutions to these issues. So that's the reason why today I'm going to tell you something. Take it as a Bitcoin as well. That's the same pattern to me. And you must really listen carefully to what I'm going to be saying today. The huge problem most of you guys have right now is to think about the fact that something that happened must reproduce. Yes, it does, because that's exactly what risk limitation is all about, using patterns and structures to replicate. But what the strategy is also telling you, and that's the reason why we start with the third range boundary first, is that things never reproduce the same. They shift in both amplitude and cycle management. So take it as it is, and take a quick chart in here to explain what I'm talking about. So if you basically account for this, okay, take an axis, okay, that would be that, okay, we go from point A to point B, okay, and we have multiple ways of doing such a thing, okay. The first thing is we take 70% of our time on the bullish cycle, and we take 30% of our time to consolidate, okay, considering it the bullish portion of one cycle and the bearish portion of one cycle, okay? So in that perspective, approximately 70%. Whoa, I'm trying to do my best, but okay, 70%. On the opposite hand, we can take another thing, okay, another option in which we take just this, 10% rising, 90% consolidating, okay? In that perspective, what we've just created in here is just a different way of doing the same thing. Okay, we've made one bullish oscillation, one bearish oscillation. We just totally shifted the spread. Okay, 70% to the upside, 30% downside, 10%, 90%. Okay, so that is the variation for time spreading into a cycle. Okay, though that doesn't mean that this cycle is going to be a bearish market. You would say, yes, it is. I mean, if we spend 90% of our time in a bearish cycle, prices obviously have to be lower. They do not. That mostly depends on how much time do we spend to the upside or to the downside. And that's exactly where I think a lot of people are having trouble with Bitcoin right now, and they're going to have a lot more in the future if they think it that way. Okay, we can spend and have a raging bull market that spends 10% of its time rising and 90% of its time consolidating. Only the thing it has to do is to surge radically during this 10% and consolidates just a little thing, on the 90%. And I know these structures are pretty rare. That's not a conventional way of moving from point A to point B. That's not a conventional way. Most of our time, like I said, we're going for some more general type of structures in which we rise more and we consolidate. We're much more used to these structures rather than this one. But still, statistically speaking, these rarely occur, but they still do. And I think that's exactly what we've experienced with Bitcoin. We seriously have shifted value from this area, the 10K, to this new area, 40K. The thing is that you think, like, this is just that. This is something we're going to keep on pushing. We've made fourfold in just a few days. And people tend to believe that this is a sign of a raging momentum and that we're going to go to the moon. Fuck it. We are trending. Stop repeating the 2008 bubble crisis type of mode, because that's not what it is. It's totally different structure. We totally have different market participants, but we can still see people who are thinking that replicate is inevitable. It could still happen because, of course, there are still some unexperienced traders jumping into this market for doubtful reasons. But still, if we go for a trend, don't get me wrong, if we are moving from point A to point B, and if this point B is expected to slightly later on move us to a point C, okay, we're gonna have to create another cycle. In my personal opinion, these are the cycles we've experienced. Low point, high point, low point, high point. Okay? Which means, well, where is the next low point? That's the big question. We've made hell of a ride to the upside. Are we going to get just a tiny consolidation and keep pushing? That would be fairly parabolic scheming shit. Or are we going to consolidate for much longer because we just put it fast forward before? And in that perspective, maybe this is going to be 30% of our global cycle. Maybe we'll still be dealing with the 40K area by July. And we would just be doing something very painful in the meantime, some volatile, boring shit, or low volatile, or whatever, but we're going to have to stand and stay pretty much out there for a long time. And that is going to be heavily painful. Because that's exactly what I told you in the 1st of January's plan for me. I think this year is all about fucking timings, and people would just be mad at it because they will try to replicate what happened in 2020. That's not what's to be expected for the year ahead. Most importantly, just like I told you so, I think, well, rationally speaking, March is a pretty fast structure for consolidation. And just look at where we are right now, and people are already driving themselves crazy about trying to forecast this market. They look at short-term trend lines and stuff like that. Like, now everyone have this one on their chart because that's where we rebounced yesterday. And there is also this one, and what the fuck? I mean, think of it. We're barely even halfway through. We're already halfway through January, and if we have to go through March or even longer than that, then do you really think we're not going to get out of this triangle? Yes, we will, but does that mean we're going to get to trend? Probably not, which means this range is probably not the appropriate reference time frame, which means we have an H1 time frame mature range. How about we turn it into a 4-hour? And if this 4-hour range is not yet enough, how about we turn it into a daily range later on? So we're probably going to range on multiple time frames at once. And it's already clearly dangerous to trade a range on one time frame. It's not the easiest solution. It's not the easiest structure to navigate. The only low-risk trade is a range is a goddamn third range boundary. The rest of a range is boring fucking noise. And remember that time can be a bitch in a range. No one can predict what range structure we'll get. But some people nowadays are playing this game. They're playing this game of, okay, clearly there is a triangle. Okay, fine. And what happens if this range is just the early stages of a 4-hour building range? And in that perspective, this would be a range inside a range. Therefore, this range just means nothing. And I think that's exactly the big mistakes most traders do right now. They want to make day-to-day analysis because they have a public and they want to keep up the audience. So they're releasing day after day updates on cryptocurrencies or whatever thing. There probably is nothing to say. And I can hardly be honest with you, more honest than that with you guys. there's nothing to say about the crypto market right now. Rather like to be patient rather than trying to forecast something that is so chaotic that actually no one is able to forecast. I can definitely tell that we're going to break out of this triangle, but I don't think the breakout is going to mean anything. I think this is going to be fake breakout or reaching out to some potential boundaries. Like I said, I think 26K to 28 can eventually be reached out to, just like I think these areas, the 40K, can be tested again. Where are we? Sitting in between. And that's exactly what I forecasted since the first day of January. I think we're going to oscillate across 34K. And I think we're going to spend quite a lot of time in here. And God fucking knows what the structure of this range could be. I think these are the areas that matters. And as every smart money manager knows that now, we're probably going to spend most of our time randomly oscillating in between. So 34K, it's already beginning to be exactly what I thought it would be. A boring fucking range oscillating across 34K. Because as we move on, everyone is now starting to see my risk management areas. So as more and more people start to see these demanded areas, we're probably going to stay in between. Because there's no reason to get there. We're going to wait for external catalysts. If we have, I don't know, external bullish news for the stock market or whichever, whatever, bam, we're going to get there and then rapidly reintegrate. Bad news, bam, and rapidly reintegrate. But these BAMs, how the fuck can you predict them? So that's the reason why I think there's nothing to say. As long as the market is stuck around 34K, don't gamble on one way rather than the other because you have absolutely no chance to know. So just don't do it. Just be patient. It's not about trying to give any rational sense to chaos. I think it's all about just assessing the fact that we know shit and that we just have to be patient. Okay, that being said, I'm going to leave you guys with that.